Thank you. It is my great privilege today to have the opportunity to introduce Steve Schwarzman, the chairman and other co-founder, along with Pete Peterson, of the Blackstone Group. Steve built Blackstone in just 24 years into a leading global alternative asset manager and financial advisor. Those are the words on the Blackstone webpage, and I thought they were perfectly apt and a good description of what they do. Steve took Blackstone public in June 2007. That was just as I recall we were seeing the first signs of the crumbling subprime mortgage market. And Steve has navigated the dangerous waters of finance that have appeared since then. And I think we're all here and we've got a good crowd because we're interested in his sense of whether those waters are still rising or whether we can soon see them leveling off and start to recede. Steve is a graduate of Yale. He has an MBA from Harvard, and he's continued his association with both of these institutions. He's also provided strong leadership and support to cultural institutions, including the John F. Kennedy Center for the Performing Arts and the New York Public Library. I know from having heard him before that Steve has a worldview that is global and also reaches far beyond finance. And I think that is the kind of perspective that we need to have today to understand where we are and where we're going. And therefore, I'm looking forward to hearing his perspective, and I'm sure that you are too. Steve?
Thanks a lot, and thank you everybody for being here. There's very little more topical than the financial world, the economic world that we're living in. It's always reassuring to know that you're in the right place at the right time when you're going to the Japan Society, when you pick up your Financial Times in the morning and what's on the front page. I'll read it to you in case you don't get the Financial Times. It says, plunging export demand pushes Japanese stocks to 26-year low. Record current account deficit stokes concerns. I could read you the article, but it would be too depressing. They talk about GDP declining at a rate of roughly 13%, which may be revised higher as of the fourth quarter. I happened to be in Japan. It was a really fascinating few days, about 4 weeks ago. And as happens on trips like that, the culture is unfailingly courteous. You get received by the top people at the major companies, both financially and others, and you get a real sense of what's going on. That Japan itself, of course, was extremely surprised by the consequences of the meltdown on September 15th. The Japanese economy seemed to do pretty well for a month or two, and then at some point in November, just turned down in a very precipitous way. And it's experiencing the worst decline, really, in decades. And one of the things that was on people's mind when they were talking to us was really about the restructuring of whole areas of industry in Japan, particularly the auto business and the electronics business, and whether we could help both with our private equity arm as well as our advisory arm. And what was quite interesting is that the people that we met with were absolutely calm, very cerebral, and recognized that the problems were not the problems of the earlier bubble economy in Japan, but that these problems were operational and that they were global, and that simple restructurings of companies in Japan in those industries was not the answer to the situation of what was going on, but really you had to restructure an entire industry, as you're seeing in the auto industry, both U.S. and what will be Europe, as well as Japan, and that they wanted to work with potentially with a firm on some of these problems that had that kind of global capacity and the ability to not only deal with companies but deal with governments, because the world we're moving into is a much different world than virtually everyone who's here at Japan's society and has grown up in the world we live in has experienced. This has been an exceptionally fascinating time for those of us who are in the financial business. We're the first group that sort of sees what's going on. The industrial economy typically feels what's happening afterwards. And I think the problems of what's going on are really at this point, exceptionally well known. How we got there is actually, pretty simple. You've had enormous buildup in leverage over really a 20 to 25 year period, accelerated in the last 5 to 10, and that manifested itself in different levels of extra demand for consumer, for products, demand for housing, and the particular asset class that started the collapse, of course, was in the subprime area, which was again encouraged by the U.S. Congress, aided and abetted by the use of Fannie and Freddie, as well as by people generating mortgage product that shouldn't have, people who bought homes who weren't qualified. And people often ask me, well, can you put your finger on one thing that happened? And the answer is there are just so many, you don't have to really do that. But what's pretty clear is if you were looking for one culprit out of the many, many, many culprits, you'd have to point your finger at the rating agencies, because as subprime mortgages started getting produced, they got packaged in securities called CDOs, and the strips, as you know, of the CDOs were rated from AAA down to much lower ratings. And if the AAA piece, which has turned out to not even be close to AAA, was originally rated BB, there would be no subprime mortgage crisis, because nobody ever would have bought the paper. And if nobody would have bought the paper, you could not have had the enormous amount of product, which was not only sold in the United States, but because it was rated AAA, that product was sold around the world. And different institutions have different rules of how they deal with AAA paper, what reserves they put up against it. Some firms almost forgot they owned the stuff because there was no risk of default. And once you bought into that issue of AAA for that paper, when it turned out to be paper that was in many situations going to end up defaulting, causing immense loss, then you really had the makings of a global problem, because it was sold all over the world. We then exacerbated this problem with mark-to-market accounting, something that's relatively new on the financial stage. And the reason why it was most unfortunate that was introduced is that probably 80 to 90% of the losses in the financial system actually hasn't happened yet in terms of realized losses. They're markdowns. And they're markdowns based on where a rapidly deleveraging system is forcing out relatively small amounts of product. And one of the things that's happening is that because we had too much leverage in certain types of institutions, particularly the investment banks in the United States, leveraged 30 to 1, that they tried to get down to lower levels of leverage, and they couldn't really sell much in the way of new equity securities, because every time a firm would sell equity securities, the people who bought them would go down. The people who bought those new securities would go down, and after a while, I guess once the first 29 sales of equity went into financial institutions and people lost money, even they figured out this was probably not a wonderful investment. And that created a situation where the only way to deleverage was to basically sell assets. So what we started having was a U.S. system that was selling assets simultaneously. Everybody was selling. And if you have 4 to 5 to 6 times the number of sellers as you do buyers, then it doesn't matter how good the security is, it will go down. Just simple law of supply and demand. And the more you deleverage, which is apparently what the markets say they want, the worse it all gets, because the losses become greater, because people are marking this security to market. Could be a bank loan that's going to pay off at par, but if everybody's selling that bank loan and that bank loan goes to 60, then if you owned it, whether you sell it or not, you've got a $40 loss, even if you're going to end up getting 100 someday. And because we're marking to market with this immediacy, the only way for that institution to survive is either get government guarantees or government equity. And what we've done is we've created, through a variety of these types of decisions, as well as, in the United States, fractionated regulatory responsibility, so that nobody's quite controlling some of the institutions. You put that all together, and we have what can only be termed a mess. Now, we almost lost the system in the week after Lehman went into bankruptcy and a subsequent liquidation. For those who are not in the financial business, I don't know whether people generally understand what a close call this was. And if there was not the TARP money passed eventually, and the application of that money and more confidence, and the move by governments around the world to basically guarantee the deposit structure of their respective banking systems, all within 3 weeks. It was quite an astonishing and unprecedented type of thing. Then it's quite clear to me, and I think to most practitioners, the system would have collapsed. And the consequences of that, and it wouldn't be just the U.S. system, because you were seeing other banks around the world snapping like twigs, that the consequences of that is frankly unknowable and unimaginable. And so credit goes to the people who stepped up to take the heat, to do that kind of rescue. It was not easy to do, particularly with the media and a variety of political people having their own points of view of what might or might not have been done. I think it's totally clear that if those extraordinary actions had not been done, we would have had a much different outcome for the world economy. Now, world economy didn't turn out to be so good anyhow, but what we do have is, after that spate of bankruptcies for roughly a 6 to 8 week period, we did have stabilization of the banking system. Every once in a while, something goes wrong, and another institution needs some emergency injection or help. But fundamentally, those institutions were in effect by their respective governments selected and are being preserved. And the governments which had made some early mistakes of letting certain companies go, and in particular letting their liability structure go. It's one thing to lose the equity in a financial institution if you're the person who invested in the equity. It's a different thing if you're the debt, because what happens, debt only gets its money back with a coupon. And if you invest in a financial institution, which is impossible for any outsider to analyze, and you lose your money, you only have to do that once, and you won't do that again because the rate of return isn't big enough. And so the governments now understand that they have to protect debt holders as well as equity. But what happened in that period when the world was collapsing from the perspective of the global economy, the worst thing happened. The financial story went from the business page to the front page. This is never a good thing. Business stories should always be kept on the business pages. And when regular people saw the chaos that was leaked onto the front page, they correctly got scared. And the way many people around the world react to fear is apparently they stop shopping. It was pretty clear to me at that time, I articulated that to a bunch of people, that the fear was so big, so strong, that ceasing of shopping ceased almost all economic activity. People were just didn't know whether the world as they sort of understood it. They knew there was a big change. They knew there was a crisis. And they stopped purchasing things. And once the consumer stopped, particularly in the U.S., where you have a 70% consumer as a percent of GDP economy, that basically starts stopping everything. The banking system, which had already, not to be forgotten, had started its credit crunch in July of 2007. So by the time it got to September of 2008, it had already basically experienced illiquidity in most of its asset classes, whether they were municipal bonds, whether they were corporate loans, whether they were mortgages. The system had basically pretty locked up. And so after all of this emergency help in September, October, and the consumer stops shopping, it was clear, without having much imagination, to know that the consequences of that on the global economy would be absolutely dreadful and unprecedented, because the global banks were having trouble lending. Actually, they did a lot better in Japan. They did a lot better in Canada. But they weren't doing too well almost any other place. They're doing just fine in China. When you have that much demand removed from the economy, it will just flop over and collapse. And literally, that is what we are living through right now. Consumer demand has stayed pretty low. There's some senses it may have stabilized a bit in February. You've had global stock markets, down 50 to 60% from the top. Different countries, slightly different tops, but take something like October 07 as one definition of a top. We've had somewhere between 40 and 45%, in my estimate, of the world's wealth destroyed. That I want to just give that to you again. Between 40 and 45% of the world's wealth has been destroyed in a little less than a year and a half. This is absolutely unprecedented in our lifetime. And part of the reason you're seeing what's happening is that even if people want to start doing things, they just simply don't have the money to do it. And the financial systems don't have the size and scale to do it. And we find ourselves in a very, very difficult global situation. In Japan, since we are at the Japan Society, this problem is exacerbated by the fact that trade financing throughout the world has basically evaporated. countries are turning inward, taking care of their own industries. They barely have enough money for that. In fact, almost all of them don't in terms of credit extension. So when it comes to giving money to outsiders from that country to bring in trade, it doesn't even necessarily have to be an anti-trade statement. It's really, in many cases, we just don't have the money. And I actually was talking with the head of a central bank who had an economy based on exports, and he told me he was leaving deposits from his central bank with, in this case, it was the European banks, so that they would extend letters of credit so that he could export. Sort of an unusual, way to create export demands, and you've even seen with Toyota, using central bank reserves in Japan to basically help with their export business. Now, where does that leave us now? We've got a new government in the United States. We've got some very smart people in many of the European countries who have an uncharacteristic predisposition to action. They want to do stuff. You've got an expanded set of decision makers from a G7 world. We've now moved to a G20. We do have some pockets of strength. China is committed, as you know, to somehow getting to their 8% growth level. I don't know how they'll do it, but they certainly have the money and the commitment to do it. India is slowing down, but the Indian banks are in good shape, and their economy is likely to be somewhere, sort of the guess is 4 to 5% growth. Now, for these countries, this feels like a recession because their growth rates are chopped down by 5%. When you start in the U.S. at positive 2, then you go down 5, you're negative 3. It's got the same feeling as these other economies when they go down 5, but they're still in a growth mode. Now, what you're seeing with the new government in the United States is they believe they've come in with a mandate. They did indeed win, and change in the United States, for those of you in Japan, is always regarded as a good thing. Whether it's a good thing or not, it's regarded as a good thing. We like change, and we don't mind trying new things and having them fail. Anything's better than just doing nothing, particularly when there's a crisis. And at this point, everybody in the United States recognizes that this is a crisis. We've got 1 out of 9 people who cannot pay their mortgage on time. We have an increasing consumer losses from credit cards that are going to grow pretty substantially this year. We've got unemployment going up. It's at 8% now, 8.1, going up at 600,000 people. That'll level out after a while. Won't stay at that level. But every time it does, it goes up like 400 to 500 basis points. So if you imagine doing this for a few more months, you get really close to 10%, pretty quickly. Although what's happening is that most of this unemployment is coming from the first shock after September 15th, as companies realized there was no demand and they're downsizing. And the question is, will you hit another plateau where things look like they're not getting so bad, at which point the number of people being let go will decrease in terms of absolute numbers. If things just keep going down, then there'll be second round of cuts at all the companies, and you'll see increased levels of employment. And the more you get into that cycle, of course, the more losses for the financial institutions, and lower stock prices. And the lower stock prices create their own difficulties particularly with pension funds. We'll probably at some point need to have a modification or suspension of money put into corporate pension funds because if corporations are in enough earnings pressure, if they have to keep putting more and more money into the pension fund because the pension funds are losing more and more money, then eventually they can't run their business correctly. And if they can't run their business, they can't hire the people. If they can't hire the people, the whole system gets worse. So there's a series of complex interrelationships that are working on the downside now. All of us in this group and anybody who's on webcast basically experienced most of their life as an adult, if there are adults watching this as opposed to just kids, experienced most of their life with things going up. And the wonderful positive reinforcing benefits of an expanding economy, although it was hard in Japan, for really a 10-year period. They managed to get through that. But the rest of the world was still growing. And now the consequences of an economy going backwards are really sort of laid out. Now, the issues that everybody always likes to ask are, how long will this go on? Will we get out of this mess? What's going to happen to me? That's sort of more or less what people have on their mind. How long will this go on? The answer is for a while. And nobody knows exactly what a while is, given all of the issues that we're facing. What's most important is what are we doing about it? And I think that you're seeing, and will continue to see, the U.S. government and a variety of other governments reacting with huge stimulus programs. And if they haven't done it, their population will end up demanding that. And they will also pursue a variety of mechanisms to stabilize their financial institutions. And they will all lower their interest rates to create a positive yield spread for the financial institutions to reflate their equity, to replace their equity. If necessary, governments will put equity money into the banks so that the banks don't collapse, because if they collapse, that's sort of the end game where you can't get a society moving again if your intermediaries are all impaired. Now, I'm sure you've watched, Tim Geithner, who's a very smart guy, actually, introduce a series of programs. The Obama administration, for whom I don't officially speak, but like all Americans have an opinion, and certainly observe what they're doing, and what they say, I believe they mean, which is they are unalterably committed to the preservation of the principal financial institutions in the United States. They will not let them go down. And they will do whatever they can to stabilize those institutions. And in addition, they will do whatever it takes to restart the economy. Most of you probably would not know that in the financial area, banks only accounted for 20 to 40% of the loans that actually were made. The number depends on what type of loans at what point in the cycle. Most of the loans and greater extensions of credit were made by different types of institutions, or some that were just sort of invented for the moment, which were called collateralized loan obligations, where you would get some money, put it up as equity. The capital markets would lend you a whole capital structure like you were a mini bank, again rated AAA, AA, single A, and so forth. And then you would go out and take that money and you would buy bank loans, or you would buy junk bonds, or you would buy asset-backed financings, credit card financings or student loans or whatever. And there were, many types of asset classes that basically existed, and the economy was powered by those buyers, and those buyers are virtually all gone. So the issue of quote, dealing with the banks is an important issue, but it is not the defining issue, because banks simply don't have enough capital, nor did they before they were damaged, to basically power the economic expansion that we would expect, certainly in the United States and Europe. So what you're seeing being done now is both the Fed, which doesn't have to go to the Congress for its money with the kind of regularity that the Treasury does. The Treasury basically had no money, and that's why they went and got the TARP so they could deploy this money places, is they are using every kind of program they can think of to establish a demand, but one, to protect the banks, have the banks get back to lending, and create these near banks, if you will, that can extend credit. And that's how you get all these funny alphabets. The TALF, I don't even know what it stands for, TALF. And if you speak Japanese, it doesn't matter whether you speak Japanese or you speak English, you still wouldn't know what a TALF is. But basically, what the government's done is they're making, through the Federal Reserve, leverage available to set up these new same old structures to finance credit card receivables and auto receivables, student loans. They're starting in the consumer area, and they'll lend leverage up to 11 to 1 or sometimes higher on these assets. Their objective is to bring private capital into the system, and by giving a 15 to 20% return for that private capital, they are trying to pump prime the system so that you can create new auto loans and credit card loans and the like. There will be a program set up soon to buy troubled assets from the banks. The TALF basically so far is just producing lending money for new assets that are being created, but there will be a program in all likelihood that will have the private sector buying troubled assets to clean the banks out in terms of providing leverage for that as well, so that we can get more money back into the banking system. The private sector will end up making some good money doing that. I think there's some real complex issues of how you price that type of product. If you price it too low, you destroy more bank capital. You price it too high, the private sector makes too much, which is one reason why when the TARP was set up, they couldn't figure out how to really execute on it. It's very complicated. But there are a lot of clever people spending enormous amounts of time and what may turn out to be an almost unlimited amount of money to get the financial system lending again. Ultimately, that will be successful. It will not be successful instantaneously because it takes a while just to even set up these programs, let alone get people brave enough to put their money up in the equity underneath these structures. And the banking system itself is under increasing pressure from losses and has been cut off from their normal sources of equity capital for the most part. As their stocks go down, people are less likely to invest with them. So, we have a problem that isn't just of confidence. We have like a real problem, in the financial system. Typically, we get out of all of our problems in the global financial system if we keep interest rates low enough so the banks can borrow cheap enough and they overcharge their customers to create, with very big spreads, which goes into their equity so that they rebuild their equity. And the more equity they have, the more money they can lend over time, which is a good thing. And that doesn't happen in 1 or 2 quarters. It doesn't happen in 3 or 4 quarters. It really takes a while because at the moment we're manufacturing losses at a pretty good pace. And we also need, the overlay to this is regulatory reform. Everyone in the world wants regulatory reform. It is ironic that most of the institutions in desperate trouble are all regulated. I don't know why people don't recognize that, but apparently we need more of it. If we're going to have more regulatory reform, which conceptually is a good idea, we better do it better than the way we've been regulating institutions so far. There are going to be a lot of challenges that go with regulatory reform, and there is always the opportunity for well-intentioned government officials to damage a system further than it already is, or hamstring it so that when we come out of this, we have a different style of economy which does not permit the kind of innovation that we need to enable each of the economies to grow, because it's only with growth that citizens actually do better over time. It's not really by taxing one group in society to give a little bit of money to another group in society. You really have to expand the society and create jobs and create wealth. And there'll be some real challenges, I would predict, at the G20 meeting in April, where the Europeans have a very fulsome idea of what they think regulatory reform means. I think the Americans are probably somewhat slower on that because they're more interested in re-stimulating the economy. And you probably saw this week that I guess Larry Summers was saying we're interested in fiscal stimulus, and got back some kind of communication that sorry, we're really interested in regulation. Our Treasury is really understaffed because of the approval of new people, and to develop a mature regulatory regime, I think is going to be really hard, over the next 3 weeks. It's just not there yet on the U.S. side, and that stuff has to be done very, very carefully. So I'm not bringing you a message of complete gloom. The world does go on. It just looks terrible. It's exacerbated by the internet. It's exacerbated by the media. If you have a business channel on for, 14 hours a day, there isn't that much business news. It isn't that interesting. And so, what happens is that you start creating news. And you beat the drum because you also need viewers. And that element is creating a immediacy to problems and reinforces certain problems and tends to create certain types of problems. And the other part of the world that's unique now, as compared to the different crises that we've had, is that the internet has some wonderful attributes, but one of the things it does do is you can communicate with everybody in the world virtually instantaneously. And in certain situations, that's a wonderful thing. In a financial panic, that is a really bad thing because the nature of that panic gets amplified. And so we have very little friction in global markets anymore. And it's a little like being on a boat, and everybody starts out randomly placed on the boat, but for some reason, everyone decides to run side of the boat. So the boat starts tipping over, and then people say, oh my God, I'm going to fall over. Let's all go back to the other side. And they all run over to the other side, and all that happens is that the amplitude of each swing of the boat gets greater and greater. And that's one of the other elements in this crisis. I was talking with some people in Washington over the weekend, and it's really difficult to manage a global crisis when everybody's commenting on it as if you are supposed to do something every few hours. And if you don't get an immediate response to, a program in 3 weeks, it must not be any good. And the actual real world doesn't work that way, particularly when you have institutions that are strained and damaged. It's no different than going in a hospital just because, you'd like to feel better soon. If any of you have ever been sick out there, you don't necessarily get well on the schedule that conveniences you because you want it to be fast. It takes as long as it's going to take. And we now have a whole series of destructive mechanisms set up to not allow that healing to occur. So I think one thing is we're going to need some leadership throughout the world that articulates that, gives people confidence, because we will get through this, although this will be a mess for a while. And we can't ask more of all of these systems than we can, than they're capable of giving back to us. So anyhow, that's a little view of the world as I see it, and I guess we're now open for questions.
Thank you, Steve. On behalf of the audience, I want to thank you for what was an extraordinarily clear, I think, exposition without suppressing how complex and multidimensional the situation we're in is. And I think it's very useful. I would like to take advantage of my position as the moderator to ask you the first question. You wouldn't put a date on when things might turn around, but I was wondering, as somebody from the industry that's got the financial capacity and the understanding to be able to move in more actively when you have the sense it's zero, what are you going to look for? What are the signs going to be that we're reaching a turning point?
Well, for different asset classes that we're involved in, there are different things you look for. If you're in the private equity business, just in terms of buying companies, what you want to avoid is catching a falling knife. What it does is it severs the tendons in your hand, and it's not too pleasant. And so you can be too early. So in the private equity business, the sign that what I think you should do, it's pretty easy actually, is you should be buying non-cyclicals at very low prices that can sustain a difficult environment if those types of transactions are available. The prices always come down in a recession because the earnings come down, plus people are scared, plus there isn't much financing. We believe, and our experience is, that on those types of transactions, if you buy them right at 4 to 5 times EBITDA, you can make 3 to 5 times your money for your investors, even if you only get 1-to-1 leverage. It's pretty amazing. In fact, the best returns in private equity come with deals purchased at the worst time in the economic cycle, and it happens every time. Now, your real sign, and you don't need to be too clever about this actually, is when the economists start reporting that the economies have turned. You start buying cyclicals, and you buy as many as you can because the world's getting good. You can see it. You don't have to be too early. You can lose the first 10% of market move, no problem. This isn't a liquid securities business. It's buying companies. And that becomes a very good thing to do. Then you do that for a few years, and then you start selling those and buying non-cyclicals again. I'm giving away all of my secrets. But, it's also logical. I don't understand why everyone doesn't do it. And they all get scared to give you private equity money, at the bottom where the great returns are. But that's the way cycles always work. People like to invest at the top, apparently. So that's where that is. In terms of buying debt products, you can buy those before you hit the bottom. And there are a whole category of investments that you can make as a result of this forced deleveraging of the global system, where you can buy senior layers of certain types of securitizations where you have virtually no prospect of loss, and you can make returns today of 15 to 20% safely. It's really quite remarkable. And there are all kinds of asset classes in between where you can take a bunch of downside because you're buying the most senior security and you're not trying to guess where things are. I'm giving you the conservative way to invest with large returns. So each business we're in, for example, in real estate equities, you should keep away from that now. If you think it's cheap, it will be cheaper. And so there's no rush to be doing that. And you'll see, when the right time is for that asset class. And I'm also speaking globally on each of these asset classes that there's a time when you can see that you have to get to the point, for example, with office where the vacancy rates just stop going up for a while. You don't want to guess where that stops because you could be wrong, and that would be like a catastrophic thing, being wrong. So there's different poise points in each investment asset class when you would want to be active.
Well, thank you very much. That's very, very useful, I think, additional perspective. We'll turn to the audience now for a few questions. We don't have a lot of time left. Please wait for the microphone, identify yourself, and ask a brief question. Right down front here. Who has the microphones?
Thank you. Bal Das from Inscap Partners. Steve, one question I have for you is, you identified...
You should hold your mic up a little. So
Sorry. You identified, as a result of this unprecedented situation we are facing, a four-pronged effort underway by our new administration, which will have long-term implication. I'd be interested in your thoughts on, in the financial services sector, in the medium to long term, do you think that it is going to have a fundamental effect on human capital, how it is built up, which goes to the core of sustaining the financial services sector? I'd be interested in your thoughts.
Yeah, I think the question was about, are we going to change the recruitment and development of people going into the financial sector? And I think the answer is that we will, certainly over the next few years, drive people away from that business. Hardly anybody will be hiring them, and that will last for quite some time, actually. There's a surplus of human capital right now in an industry that's shrinking. You've got the problem of the government limiting compensation for the companies that took the TARP money, which will result, if that's not reversed in some way, to great difficulties for those companies, and those are the biggest companies in finance. Some people will repay TARP early, some people will not be able to, and they'll lose their best people unless that's rescinded or modified. So I think the glamour and the endless upside that I think young people believed when they entered finance is certainly going to be compromised over this cycle. And you'll have a much more regulated business. And I think to fully answer your question, you really need to see what comes out of the regulatory regime. If there's real regulatory excess, then that will greatly diminish people's desire to enter this field. I've heard all kinds of really strange proposals that people are talking about that would change the world you live in. And most of these hopefully will not get any traction.
Another question? One over here on the aisle.
Hi, Joy Botchford, the Astor Group. I was a little bit surprised that you're highlighting the rating agencies for blame. While it seems to me clearly they do deserve a lot of blame, it would seem to me also that the investors who bought the paper that was rated by the agencies and presented themselves to the world as highly sophisticated and expert and able to separate out opportunity from risk, and therefore deserving of compensation that probably generally tended to be many multiples of what folks at the rating agencies got, that they too deserve a great deal of blame. But leaving that aside, I wondered if you had any specific suggestions on models that might be deployed to price the impaired assets that most feel banks need to sell. You mentioned the impact of mark-to-market accounting and how that is depressing values, perhaps in many cases below where they should be, and a need to price the sale of impaired assets at a level that is not so low that it further crushes bank balance sheets, but is not so high that it eliminates the opportunity for the private sector to make an attractive return. Do you have any suggestions with regard to models that you feel can be deployed on a countrywide basis?
On your first comment, people who are not in the financial business would probably be surprised to know how people in the financial business regard the term AAA. In my memory, and I started in finance in 1969, I know that's hard to believe, but that's true. I don't know of any AAA security that ever defaulted. That's why they're AAA. And so AAA has sort of almost a religious connotation in finance. If you call it a AAA, you don't have to analyze it. That's why it's a AAA. And so the reason that we got into this trouble is that people were selling these securities because they were AAA. They didn't analyze them very much because they were AAA. They never could default. And people who bought them didn't either because they were AAA. If they were AA, they would have analyzed them. If they were single A, they'd be all over them. If they were triple B, they'd be all exercised, and if they were double B, they wouldn't buy them. But AAA, you just never, ever, ever thought about the credit goodness of it, and that's globally. And so that's why that all occurred, and that's why the rating agency is a problem. They put the ultimate good housekeeping seal of approval, and there are special, sort of value at risk rules where you don't have to count AAAs for, on risk models and other types of things. And so the whole system was based on AAAs never defaulting. And until this one little period here, they never did. Okay, so that's the answer to that. In terms of models, I was relatively good at building model planes when I was younger, and occasionally I could put a ship together. But financial modeling has never been my long suit. That's why we've got smarter people than me at Blackstone. And so I don't know that anyone has the answer to your question. There are a lot of people struggling with the answer to how do you value all this paper and what is the appropriate model. It's an issue of enormous focus. And one thing for sure, you're either going to be too high or too low. You will not get it right because it's just too hard. It's too improbable, percentage-wise, to get something right that's got that many dynamic factors affecting it. So I'm going to completely punt on the answer to that question.
Okay, well, we have time for one more quick question. Here in the middle.
Dorothy Hung, under this economic climate which you just described, do you foresee increased number of activities and collaboration between Asian entities and American entities?
The answer is yes. Asia's got some really great things going for it. One, they have a lot of money. Two, they tend to have, and in this regard, unfortunately, I'm at the Japan Society, but a lot of other places in Asia are going to have a lot of growth through this cycle. And so for investors looking, for growth, that's going to be good. For economies that have difficulty, like Japan, should be having, there'll also be great opportunities to operate jointly with, investors and institutions in Japan to buy, whether they're troubled assets or investing companies. And one of the things private equity does is help turn companies around, make them better. And there will be good opportunities, for that too. So I think, and we're expanding our activities in Japan, and we believe that there's going to be a lot to do coming up over the next few years in Asia. So thank you very much.
Okay. Well, thank you, Steve, on behalf of the Japan Society and the audience for what I think is a very rich and, again, clear review of a complicated situation.